If the stock market feels like a roller coaster, a bond ETF can be your seatbelt, steady, simple, and built to keep you from flying off the ride. In the next 3 minutes, you'll learn exactly what a bond ETF is, the real risks, and a quick practical way to use them. Stick with me to the end for a 3-step template you can copy. A bond ETF is a basket of bonds. Think of it like a bundle of IOUs from governments and companies, wrapped into a single share you can buy and sell like a stock. Unlike buying one bond that pays you twice a year and eventually matures, a bond ETF holds many bonds and pays you monthly income as interest flows in. It never matures. Instead, it keeps replacing older bonds to stay aligned with its strategy. Why do investors use them? Diversification without the headache of hunting individual bonds. Liquidity, you can trade during market hours. Transparency, most funds publish their holdings. And convenience. Want US Treasuries, investment-grade corporates, or even inflation-protected bonds? There's likely an ETF for that. But bond ETFs aren't magic. Prices still move. The big lever is interest rate risk. Picture a seesaw labeled duration. The longer the duration, the more the price moves when rates change. Short-term funds wiggle, long-term funds swing. There's also credit risk. Bonds from shakier issuers can pay more income, but may drop faster in stress. Add tracking error and fees. Costs still compound. Here's how to use bond ETFs the smart way. Step 1. Define the job. Do you want a cushion for volatility, steady income, or a place to park cash for the next 1 to 3 years? Your goal decides your mix. Step 2. Match duration to your timeline. Need the money in a year or two? Favor short-term funds. Building a long-term core? An intermediate-term broad bond market ETF can be the portfolio's shock absorber. Step 3. Build a simple ladder with ETFs. Split your bond allocation into short, intermediate, and long-term funds, say 40-40-20. Rebalance once or twice a year. When rates rise, maturing bonds inside the funds get reinvested at higher yields, and your ladder naturally refreshes. Before you buy, check 3 numbers. 1. Expense ratio. Lower is better for broad funds. 2. SEC yield. That's a standardized snapshot of current income. Compare funds apples to apples. And 3. Average duration. This tells you how sensitive the price is to rate moves. 2 quick pro tips. First, consider holding bond ETFs in a tax-advantaged account if you can. Interest is usually taxed as ordinary income. Second, automate contributions. Dollar cost averaging smooths the ride, especially when rates and prices are jumpy. Here's the template. For a long-term core, use a broad intermediate-term bond market ETF as the foundation. Add a short-term treasury ETF for stability. And if you need more income and can tolerate bumps, layer a modest slice of investment-grade corporates. Review it twice a year and let the system work. Just a heads up, nothing in this video is financial advice. It's all for information only. Explore more tips on money and investing at Money Nova's website. That's the power of bond ETFs: steady income, broad diversification, and a calmer ride. Stick around for more quick and actionable guides.